Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me remotely, we have Brian Joyce. He's the managing director on Nasdaq's Market Intelligence Desk and also our resident market technician. Today, we're going to take a look at certain price gaps that we're noticing in the S&P 500. And Brian, before we get to the charts, yet another day, if you look at, an intraday chart, you think we were trading for, a couple weeks, a couple years here with the velocity of the swings.
Absolutely. It's, the volatility is here to stay. We initially were up almost 2% in the S&P, and now we pulled back, and we're down 1%. I was hoping to see some sort of upside move. Maybe I think I saw on television we haven't had two updates in about 5 weeks for the S&P 500. So that bear market rally, a more sustained rally, is not yet here. I'm looking at the weekly candlestick chart, and I'm not seeing your typical bottoming candlestick over that weekly time frame, which is something I was hoping for. If we had a good day today, we might have had possibly a hammer stick bottoming candle, which would have been a good indication that maybe a more prolonged rally is ahead.
All right. Speaking of charts and patterns, let's take a look at our first one today. This is the S&P 500 on a 60-minute chart, which is something that you and I have been following over the past couple of weeks.
Right. We're looking at the hourly chart here. Want to get a zoomed in look to see if there are any signs of, breaking that trend of lower highs and lower lows. As you can see, we've had about four pretty decent rebounds during this downtrend. We've declined a total of roughly 32%, almost 1,200 points. We did have the biggest rebound was after that first week. We bounced 10%. Since then, we had a 5% rally, a 9.5% rally, and an 8% rally, which was just this week off of the lows. But as you can see, all of the rallies have stalled right at those price gaps. And gaps, as we know, from a technical standpoint, often can act as future levels, in this case, of resistance. And that's certainly been the case here. So that trend of lower highs and lower lows has not yet been broken. The most recent gap is in the range of 24.53 to 24.76. We touched that yesterday, and we even hit it intraday today in the morning time, but we've seemed to roll back over from it, as you can see from that yellow arrow, where the candlesticks are now trending lower. On the downside, our support is 22.80. That was Wednesday's low, and that's also, as we noted yesterday, the 161.8 projection. And so from there, that's the key support level. And if we break that, then 22.63, that would be the 200% projection of the initial decline that we saw in late February. So hopefully that 22.80 level can hold.
All right, let's move along to our next chart here, the Russell 2000. Quite a bit of disparity relative to the other major averages. Why is the Russell off so much as compared to the Nasdaq 100, the S&P?
Yeah, exactly. So the small caps have been taken on the chin. The micro caps have been even worse. But for the Russell 2000, it's down 44% from its 52-week highs. That compares to 32 for the S&P and 30% from the Nasdaq 100. And more importantly, as you can see, it came within this week on Wednesday's lows. It came within roughly 2.5% of the lows that we saw in 2016. For the Nasdaq 100 to get down to its 2016 lows, it would need to lose another 43%. So it just shows you the dramatic difference in the two benchmarks. A big reason for that is the Russell 2000 has a strong weighting to financials. Financials are the number one sector in that index. They have a 25% weighting. And if we look at, say, the S&P 500, which is about 20% away from its 2016 lows, for the S&P 500, it only has about an 11% weighting to financials. So financials, as we know, have really been taken in on the chin. The S&P 500 financials index is down 42% from its 52-week highs. And if you look within financials, like regional bank index, the KRX, that's down 47% from its 52-week highs. So certainly, a dramatic move to the downside. Small caps tend to have more exposure to that sector. And on the flip side, on the positive side, the technology sector, which has done so well, technology makes up about 14% of the Russell 2000, where for the S&P 500, technology and communications make up about 36%. So Russell just doesn't have the weighting that you'd want to have exposure to during this downtrend. The negative interest rate environment, or the low interest rate, the zero bounds, and the flat yield curve, that's really just wreaking havoc on banks. And looking ahead, what is their credit risk going to be, what are the loan portfolios going to look like, and what kind of loan growth are they going to have. So a lot of headwinds that the banking sector is facing right now.
Yeah, and that's why you're seeing that strong relative outperformance with the Nasdaq Composite and the Nasdaq 100, especially because there are no financial companies within the Nasdaq 100, and with that, the NDX and the Nasdaq Composite are so heavily weighted towards technology, which has really been driving growth over the past 10 years. So I would also imagine that's why we're seeing such strong outperformance there. But to wrap up, another sector like the financials, one of the worst performing, energy, having a really tough time. And if we take a look at our last chart here.
Yeah, so the energy sector is down 63% from last year's highs. It's down 70% from its top in 2018. This is a monthly candlestick chart. We came within about 7% of the lows that it made back in 2002 and again in 1998. That support around 160. We know what happened. The price war between Saudi Arabia and Russia has knocked WTI crude down to $20 a barrel this week. Just an absolute crash in price. And for the S&P 500 energy index that we're looking at here, this monthly chart, we could see in February last month, and we even really in late January, it started breaking below that 412 level, which has been support since about 2011. And it's a very toppy kind of pattern back there. In 2011, you had a high around 600. And then in 2014, we had a high just over 700. And then more recently in 17-18, we had a high close to around 575, 600 again. So there's that head and shoulders topping pattern. That neckline was the support from 2011 to present, which is around 412. And when that gave out in late January, early February, maybe you call it, the floodgates just opened up. And then earlier this month, when we had the price war between Saudi Arabia and Russia, that was just, the nail in the coffin. And so we're within, spitting distance now of those lows that's been mentioned in 98 and 2002. And just dramatic move to the downside for the space.
All right, Brian, great stuff as always. Always appreciate the insights. Stay safe out there. We'll talk to you next week.
Thanks for having me.
All right. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.